area of international taxation. So we'll discuss about transfer pricing in this particular uh, section. So when you say transfer pricing, what we'll understand is what is basically a transfer price, what are the implications of transfer pricing, what are the principles to determine a transfer price. So what is transfer price, what are the principles to determine transfer price, what happens in Indian transfer pricing regulations. So the key concepts in Indian transfer pricing regulations will be associated enterprises, international transaction, and arm's length price. So we'll discuss about these three concepts, and if time permits, we'll also talk about prescribed methodology in determining the arm's length price. So we'll start with what is transfer pricing and what are the key implications. So when we say transfer pricing, the first keyword that comes to our mind is globalizations. So if we say over the last two or three decades, we have been blooming with lot of multinational corporate entities setting up entities across the country. So you have subsidiaries, branches, joint ventures being established across the countries. So there is a presence. So we have, if we take Infosys, for example, Infosys has set up branches across subsidiaries across the countries. Similarly, if you have Walmart from US setting up here, so all these happen. So Amazon setting up in India. So all these things proves that transactions is seamlessly happening across the countries. So across the countries, we could see that transactions are happening either within the group entities or outside the group entities. So transfer pricing comes into the picture when it happens with the group entities. What do you think impacts? So if you think the overall objective of the group entities could be to maximize profits but minimize tax. So to determine profits in such a manner that your taxes are reduced. So you accordingly allocate profits to countries. In the next slide, we'll practically understand how this happens. As of now, we'll understand what is transfer price. So transfer price is basically the price at which enterprises transfers goods between them. It could be a physical good or the intangible properties. It is transferring to an associated enterprises. Associated enterprises, for time being, we'll understand that it is a related entity as described under Companies Act 2013 or Income Tax Act. So it's a related entity. So any price at which transaction is happening between related entities is basically called as a transfer pricing event. So what is the advantage when it is happening between related entity as compared to what it is happening in the unrelated entity? Some of the advantages could be like price concessions. When you say price concession, it is something like your discounts. So whatever you buy it or whatever you sell it at the outside market, it will be comparatively lower or higher depending upon the situation. The next advantage could be the extended credit period. When you talk about extended credit period, it's when a regular customer comes for a 30-day credit period, the due date is 30 days from the invoice date, whereas for associated enterprises, you give 180 days, which means the interest portion underlying during this period between the 30th day and the 180th day is what is the benefit that the related entity could be earning. So that is one of the advantage that these people, the related entities could be benefiting out of the transactions with another related entity, part of the same group. Now, the third benefit could be reduced interest rate. This interest rate, what we are talking about, could be related to a loan borrowing. When you are borrowing a loan from a bank or any other institution or the group entity themselves are providing your loan, it could be in such a manner that you are provided at a reduced interest rates, or you are probably given guarantee for getting a higher loan amount or a better loan scheme. So this are the benefits of a loan transaction in a related entity. So these are the advantages. Is it right or wrong to have these sets of benefits? Basically, you're trying to carry over the profit from one location to another location by giving these advantages. So typically it is allowed if it is a normal regular business scenario, but it is not allowed if it is because of the relationship alone. So we'll see how it is determined and how it works practically. If you actually take an example, let's say there is a company called ARC Private Limited in India, which is a 100% subsidiary of a ARC Inc. in USA. So it's an American company, which is the holding entity. The tax rate in USA is 20%, whereas the tax rate in India, let's assume it is 30%. Now, there is a transaction between this ARC India to ARC USA. ARC India is selling products to ARC USA at say rupees 100, whereas the market value of this particular product is 120. So now what is the impact here? India is having a lower sales of 20, which means a lower profit of 20. So at a tax rate of 30%, India will be saving a tax of rupees 6, whereas USA will be reducing their purchase cost by 20, which means their profit will go by 20. Since their tax rate is 20%, their net tax impact will be 4. So when you're combining these profits as a group, there is a tax saving of 2 rupees. That is 10% on 20 rupees. You're saving a tax of 2 rupees when you're talking in the collective books of accounts. That is your consolidated books of accounts. There is a tax saving of 2, which is typically by giving a reduced sale price. There is no other thing. It is just a reduced sale price that is resulting in this. This concept is called transfer pricing. How do you control this? How do you monitor this? So this administration policy or the process is called as transfer pricing provisions in the Income Tax Act. So now tax administrators across the globe have established a principle called arm's length principle to control or determine what should have been the actual transaction and if there is no control between these two entities. So identifying this market value is called as the arm's length principle. So we'll understand what exactly is arm's length principle. Arm's length principle has been defined by an organization called OECD. OECD refers to Organization for Economic Cooperation and Development. So this is a prime organization which determines how a business is probably supposed to happen between entities across the globe. How do you book your profits? How do you make sure that the profit is not eroded at the country where it is located at? So how is it equally distributed according to the relative economic contribution? How is the profit distributed? So understanding or guiding on this economic principle is the prime objective of this OECD. Now OECD, there are so many countries part of this OECD, similar to our United Nations organizations or the World Health Organization. There are so many countries that are part of this organization. India is not a member of OECD, but however, India is a following member, which means we follow OECD. We try to implement various regulations of OECD into our Income Tax Act, but however, we are not a member of OECD. So we are just a follower. So this becomes important because since we are a follower, it becomes important to understand what is OECD talking about arm's length principle. So this arm's length principle, the OECD has defined as where conditions are made or imposed between two enterprises. So there must be a condition between two enterprises. What sort of enterprise? Where the commercial or financial relationships, that is the regular business scenario, doesn't exist. Commercial relationship refers to the price concessions or something like that. Financial relation relates to extended credit period or the lower interest rate that we are talking about. So when such conditions exist, which is different from those which would have been made between independent enterprises, which means we are trying to say this control would not have been there in the independent enterprises. This discount would not have been there. This credit period would not have been there. This lower interest rate would not have been there. So such conditions will not be exist. So what if there is a price difference because of this condition? So then any profit which is arising because of this condition will be included in the profits of that enterprise and taxed accordingly. So whatever is beyond your arm's length price, so whatever should have been your price, at the condition did not exist between those two enterprises, such price will be adjusted in your tax. So in our example, which we are talking about, this difference of 20 rupees will be adjusted to both India and USA, which means this will be adjusted and this 2 rupees will be nullified. So it will be given a neutral impact to that difference which is arising in that difference because of transfer price is being adjusted. So this principle is called arm's length principle. So now, before going further, we'll have to understand, is the arm's length principle the best principle? Is there something else which could have been appointed, which could have been determined, which could have been decided? So we'll understand the significance of arm's length principle. Why is it significant and why is it making an impact in your business scenario? The first significance is between the parity between the MNC and the independent enterprises. When you say parity, it is giving the equal footing, that is bringing both the MNCs and the independent enterprises into the balanced outlay. So you are bringing both in the same platform, trying to understand the same principles in which the MNC is operating, the independent enterprise is also operating. So bringing a parity between these two enterprises, removing the distinction between a related entity and an independent entity. So this parity becomes important. So that is why this is one of the significance. The second significance is about determining the real taxable profits. If you see in our example, we realize that this 20 rupees is being adjusted between USA and India, which is not the real taxable profits. So this arm's length principle now will remove this distinction between of this MNC and the independent enterprises. So by adjusting the taxable profit, reducing the 20 there and increasing the 20 there, bringing the taxable profits to the real scenario, bringing it to the reality. So that becomes one of the key significance of arm's length principle. The third one is about reduction of artificial price distortion. When you say reduction of artificial price distortion, we could see that the market value is 120. We'll have to again go back to the same example. The market value here is 120, whereas the sale value is 100. So there is a price distortion. We are not selling at the market value of a particular product. So this price adjustment is not allowed. So we are trying to understand what is the market value and trying to adjust to it, or making sure that the transaction is happening at 120 and not at 100. So this is one of the significance of arm's length principle. The next one is about minimization of double taxation. When you say double taxation, there is a possibility that it is getting adjusted in one location alone, not getting adjusted in another country. Same income being treated in a different manner across the countries. So this arm's length principle will determine a universal price. It is not a universal price, which means it is 120 in India and US, which means there is no double taxation of the same 20 at the whatever you're talking about. Are you able to hear me?
Yes, sir.
Sorry, yeah. So next is about accurate measurement of economic contribution. So when you say accurate measurement of economic contribution, an Indian entity which has been established in India, it is very important that India must receive the due profit that it is receivable in the particular country, which means there is an economic value that India provides to that particular entity, the infrastructure and all those things. So whatever it is getting generated out of India must become treatable in India, must become taxable in India. So this becomes key. So arm's length principle determines the exact economic contribution, what it has to be treated in India, what it has to be taxed in India. So this becomes very significant because of arm's length principle. Now going further, is it simple? For example, let's take an example of an electronic store like Chroma, Amazon, or any other local store that we are talking about. Now I need to buy a particular laptop or say TV, let's say a particular brand of TV which I need to buy. The price at which I'll go and get it from a local TV shop will be probably higher than what you get in Chroma, and what you get in Amazon will be the lowest of all these three possible. One of the possible scenarios is this. Now in this example, there are difficulties to identify this price. There are various difficulties in identifying these three prices, whether there were relationship here, there were something else beyond relationship, some other business reason that are existing. So it's possible to actually identify the price that is being transacted in the independent enterprises. So arm's length principle, we are saying trying to identify the price in the independent enterprises. Is it possible? Is it easy, or is it very comfortable to get such pricing? That's what we are going to identify. So there are certain difficulties in determining the arm's length principle. The first one could be obviously the true comparison. I cannot compare a price which is available in a local market and what is available in Chroma or what is in Amazon. I cannot compare this. This is not at all a true comparison, because Amazon will be buying crores of products, so they might be getting a lower price. Chroma might be getting lakhs of products, so probably another lower price. Whereas the local market will be getting few units of products, so the pricing could be much higher as compared to what they're saying. So it is not possible to compare each of them independently. So the true comparison between prices between available in the market is not possible to be actually compared, because there could be so many other reasons apart from the relationship that we are talking about. Next one difficulty is about availability and reliability. It's not possible to identify the cost that Chroma is making, the cost that Amazon is making, cost that Amazon is making. As a customer, you can go and check for the prices in which it is sold to you. Identifying the cost becomes difficult. So what is the margin that is accruing to Chroma or Amazon or to the local market? It may not be available or it may not be reliable. So it becomes very difficult. Absence of market price is also in the similar lines. It is not possible to identify such pricings in the market in a common free flowing market. Now, identifying this, a government has to appoint various income tax authority looking into each of this transaction, whether it is happening in accordance to the arm's length principle. So all this is a big administrative burden when it comes to the process of income tax proceedings. So it becomes an administrative burden. And finally, one of the difficulties is the time lag. If you see, an assessment proceeding generally happens in the next year of an assessment year, or probably a little later. When it comes to transfer pricing, it generally happens couple of years after when your transaction has happened. For example, transactions happened in financial year 16-17 would be assessed at this point in time. So this gap of 2 years, probably the employee who was working with that company at that point in time would not be there. The data which should have been available at that point in time would not have been available. So you would not have been able to identify the pricing which is relevant for 2 years before. So it's a post-mortem exercise. So this time lag will become a difficulty in identifying the real price. So these are the difficulties of arm's length principle. But however, since there is no other methodology that is as approachable as this arm's length principle, the OECD and other universal guidelines restrict ourselves to this particular principle, and that is what is followed in Indian transfer pricing guidelines also. Now, when we say Indian transfer pricing regulation, it becomes important to understand what is the status of Indian transfer pricing regulations. Indian transfer pricing regulation was completely reformed or completely freshly introduced in the year 2001. So it was applicable from assessment year 2001 and 2. So there are sections from 92 to 92F which is brought, and even rules from 10A to 10E was inserted in income tax rules 1962. So this is what determines your provisions of transfer pricing. There are some key concepts that we need to understand in transfer pricing. The first one, as we said, there must be a transaction that is happening between two associated enterprises. Either or both of them should be a non-resident. So the key particular here is an associated enterprises. There must be an associated enterprises. So which means there must be a related enterprises, related entity. Income Tax Act defines enterprises independently. So it is not what is generally defined as related party in section 56 or as defined under Companies Act 2013. So this is first important aspect, which is your associated enterprises. So the next one is about nature of transaction. So what are all the transactions that will get covered under transfer pricing provisions? The first is about purchase, sale, or lease of tangible or intangible property. Second one is about services. So whatever services is being provided will also come under the nature of transaction. Third is financial transaction, that is your lending or borrowing of money. Fourth one is a miscellaneous clause, which means any other transaction which has a bearing on profits, income, losses, or assets of such enterprises is also brought under transfer pricing. So these are the four broad categories of transaction that will get covered under the transfer pricing net. It is almost like we can say that any transaction will get covered under international transaction, which is being monitored by the transfer pricing provisions. It also includes further, apart from the regular business transaction, it also includes the cost allocation and cost apportionment. So it also includes the allocation and apportionment. So any mutual agreement whereby you share your cost. For example, you have a SIP license, which is purchased by the holding entity, which is being used across the globe from all their corporations, multinational corporations, all their subsidiaries. So this subsidiaries needs to pay a share of their SIP license to the holding entity. So it could either be a cost to cost reimbursement, or there could be some benefit, which means there could be a SAP team sitting in holding entity, which will be monitoring the IT aspects of it. So the user license, the IT issues, development of new modules, and all this could be taken care of. So the cost of the employee, the infrastructure cost, all this has to be factored in. So there could be a cost plus a markup charged by the holding entity to get it refunded or get it. It has to receive such allocations from the subsidiary entity, which is also using the SAP license. So such transactions are called as mutual agreement. All these transactions must be at arm's length price. So it must be at arm's length price. Else, there must be an adjustment which should result in increase or decrease of a loss, increase of income tax, which is increase of income, or decrease of loss. So it can happen either way this, but it has to be accordingly adjusted. So which means you cannot decrease an income or increase the loss. So this is what is important as far as your transfer pricing in 2001 is concerned, which was introduced in assessment year 2001 too. It is applicable to all assessees, both non-corporates and corporates. So it is for all assessees, not just for corporate. It is also applicable for non-corporate. The due date for transfer pricing entities will be 30th November. They have to file a Form 3CB to comply with these provisions. That is, they have to report these international transactions. They'll have to report that it is arm's length price. Now, we said there are the first key term that we were talking about is associated enterprises. Next, the other two key terms which we will be discussing will be international transaction and the arm's length price according to the Indian transfer pricing regulation. So first we'll start with associated enterprises. Associated enterprises, according to Indian Income Tax Act, could be either a direct relationship or an indirect relationship. We'll first understand the direct relationship. So when you say direct relationship, one entity directly holds in another entity. When we say direct, it also includes the step subsidiaries. So it also includes the indirect holding of A to C. In this example, as we could see, A owns 100% in B Limited, B Limited owns 50% in C Limited, which means indirectly A Limited also owns 50% in C Limited. So there is a control, there is a participation in the control, in the capital, in the management of this enterprises. So according to transfer pricing provisions, A and B are associated enterprises, B and C are also associated enterprises, A and C are also associated enterprises. So that is why we are calling about directly or indirectly in management, control, or capital. What is called as common? In the similar example, let's assume A owns 100% in B Limited and C Limited. So in this case, A Limited and B Limited are related entity. A Limited and C Limited are also related entities or associated enterprises. Going further, B and C also will be associated enterprises because it is controlled by a common person called A Limited. So that is what is discussed in clause B of 92A subsection 1. So it talks about that the common person who's commonly controlling the management, control or the capital of the other enterprises will also be called as an associated enterprises. So when we use the word enterprises, we'll have to understand what exactly is the word enterprises. So 92F is the definition section of transfer pricing. Every act will have a definition section as a common definition section. In Income Tax Act or most of the act, it is section 2. Apart from that, some specific definition will be defined respectively in that particular chapters. Similarly, transfer pricing definitions are discussed in 92F. So 92F clause 3 discusses about enterprise. So an enterprise is basically a person, including a permanent establishment, who has been or is proposed to engage in any activity relating to a wide range of activity, which is basically any business activity. It could be engaged or it is proposing to engage. So through the division or subsidiary, it could be located in the same place or different place. So any of this combination will form an enterprise. So it says it also includes a permanent establishment. So permanent establishment, as for time being, we'll just understand the basic definition of a permanent establishment. A permanent establishment is basically a fixed place of business through which a business is wholly or partly carried on. So it becomes the place where you operate. It could be even a hotel residence, a hotel or a residence where you operate your business regularly could also be called as a fixed place of business. For example, even the racetracks of Formula One have been held to be called as a permanent establishments. So that becomes critical. So this enterprise, two enterprises will be called as an associated enterprises if they have a participation in management, control, or capital, either directly or indirectly or through a common thing. Now, this is what is called as associated enterprises. But going further, there is also a category called deemed associated enterprises. So this deemed associated enterprises is basically split it into two broad areas. For the purpose of understanding, we'll broadly split it into two areas. One, which is participation based on capital, asset, liabilities, and management. That is more of balance sheet item. And the second classification will be based on the manufacturing activity, and the mutual relationship. So we'll understand one by one. The first one is about holding. We said in this A owns 100% in B owns 50% in C. So what is the minimum percentage that is required to call one as an associated enterprises? So the common holding or the direct holding or the indirect holding, it means it has to have at least 26% of voting power. Only then it will be called as an associated enterprises. The second condition is about liabilities, where if one entity is giving a loan, which is 51% of the total value of assets. So if there is a total value of assets, 51% of assets value is based on the money which is loaned by the other enterprise. Then these two enterprises become associated enterprises. Similarly, if one enterprise guarantees another enterprise for a percentage of 10% or above, then it is also called as an associated enterprises. So you need not even give a loan. It is sufficient if you are just guaranteeing a money, which is around 10% of your total borrowing. Then you have a common board of directors. So in this case, let's assume there is no holding between B and C, but A appoints managing director in B, A appoints managing directors in C. That is, at least one or more are appointed by the directors, or each of the two enterprises are appointed by the same person. Given this scenario, these two enterprises, even without shareholding, it could be still called as a deemed associated enterprises. That is participation in the management. We said participation could either be on capital, control, or management. So this clause talks about management participation. The next, if the two enterprises apart from company, so far what we have discussed is more towards corporate. That is what we are talking about, the voting power and other things. Share capital for other entities, that is a firm or another entity, whatever we are talking about. If the two individuals, if the same individual is managing both the entities, if Mr. A is managing companies B and C, then again B and C becomes associated enterprises. Or A not being a direct owner, is being controlling through a member of HUF or some other relative of office, then also B and C will become an associated enterprises in this example, without having a shareholding structure. So this is what becomes the key. Similarly, one enterprise is a firm, AOP or BY. If it's related to a firm or AOP, then at least 10% of holding is sufficient. It need not require 26%. It is sufficient if they hold 10%. So that is about the whole determining the participation based on capital, asset, liabilities, and the management control. Now, the next one we said it can also be decided by the manufacturing entities. So this manufacturing entity could be manufacturing based on the technology provided from the particular person. So there is one entity which is giving a complete technology. I'm manufacturing a car, the design, the development process, everything is given to me a particular entity. Though they are not holding anything in my entity, though they are not controlling in any form, if I'm still dependent on their technology for 100%, which means I'm paying them royalty for the entire sales, then my entity and the respective entity which is giving me technology could be also an associated enterprises. When I say technology, it includes all this which has been listed here. And next you have raw materials. When you say raw materials and consumables, when you're purchasing at least 90% from the same entity, which means there's a chances that the price and conditions of such purchase transactions are influenced by the other person. If a particular entity, for an example, a franchisee outlet or a particular outlet is purchasing soft drink only from one particular company and it is not purchasing from anyone else, then there's a possibility that there's a price and conditions that is happening between them. So then these entities could also be called as an associated enterprises. So that is 90% of supply, or if there is any price and other relevant conditions are influenced by anyone else. Apart from all this, the final disclaimer clauses, any mutual relationship that coexists whereby there is any control that is happening, then that is also called as an associated enterprises. So these are all the list of associated enterprises. Going further, we'll have to understand an international transaction. So international transaction is basically with whom, with what should be the type of transaction, what is also included as a transaction is what has to be understood. So according to Income Tax Act, any transaction between two or more associated enterprises, either or both are non-residents, are called as a transaction. When you say transaction, which means it could be based on an arrangement or even an understanding, it could be oral or writing or it could be anything. It need not be legally enforceable. It is still an arrangement. It is still a transaction. So So such transaction between two or more associated enterprises, which has to be where either or both are non-resident. We already spoke about the type of transactions. So also the cost allocation and reimbursement of charges is also an international transaction. Not necessarily between two associated enterprises. If it could be proved that the transaction is happening between B and C, whereas both this transaction is determined by A, another entity, which is not holding any participation in management, control, or capital. It is not an entity with which B is transacting or C is transacting. Then, if it could be proved that there's a prior agreement which controls the pricing, that controls the prices are determined or conditions are determined based on these entity, then it will be called as an international transaction. That is a deemed international transaction. So in this case, they need not be an associated enterprises. It could be two independent entities. Probably one associated enterprises of one of the entity is controlling transactions of these two entities. So in this case, it could be called as a deemed entity. So that is what is called as an international transaction. So each one of has been defined. So when we say tangible or intangible property, tangible property refers to everything which is listed here: building, transportation, vehicle, machinery, equipment, and all these things. Purchase, sale of intangible property. So when you say intangible property, it includes royalty, trademark, franchisee fee, license, any design charges, or anything of that sort. Then when you talk about provision of services could research and development expenditures, your marketing strategies, and all those things. Any IT related services, accounting, legal, all this falls under provision of services. And it also includes any business restructuring. So this is one transaction where it doesn't matter whether it has a bearing on income or profit or losses or assets of the entity. So if it's a reorganization, that is a merger and acquisition or something, then it obviously will fall under this category of international transaction. So apart from all the transactions of business restructuring will be considered as an international transaction, irrespective of whether it has a bearing on income, losses, assets, or the profits of the particular entity. So this is also becomes a type of international transaction. So these are all the transaction that is listed as international transactions. Each of them has been defined independently. What is marketing? What is technology? So if you see some of the thing, even human capital is listed as an intangible. So these are the list of intangibles. Even contract list, customer list, any human capital, any location, the mineral rights, location, or water rights, all of this could be called as a intangible. Even the process, any surveys, any studies, so everything. So if you see, the list is so wide, so anything and everything could be listed under purchase, sale, transfer, or lease or use of intangible property. It could also relate to all this contains your intangible property transactions. So arm's length price, we have already discussed what is an arm's length price. Income Tax Act determines 6 methods of arm's length price. So it is broadly divided into traditional method and transactional method. So OECD has defined these 5 methods, whereas this other method has been prescribed by the Income Tax Act. So traditional method are 3 in nature: comparable uncontrolled price method, resale price method, and cost plus method. Whereas transactional method is about profit split method and transactional margin method. The other method is also been prescribed by the Income Tax Act. So that is all about transfer pricing today. So we will understand this further about transfer pricing a little later in the next session. Thank you.
Thank you, sir. Thank you very much.
Thank you.
Thank you, sir. Ma'am, ma'am, can we make Divya sir as a co-host? As already. Okay, fine, it's fine. Hello, Divya sir. Welcome once again. Hello, sir. Am I audible?
Okay, so thank you so much, Satyam. Thank you so much, SuperProfs. I mean, for having these kind of online classes. So it's really beneficial for our students, and we are able to connect with a lot of people over here. So सबसे पहले ये बताओ, can you guys hear me? Can you see me properly? अच्छे से, I mean, आवाज आ रही है मेरी clearly?
Yes, sir.
Okay, मैं देख रहा हूँ.
Ha. Clear.
Am I visible?
Perfectly fine, sir. We
ठीक है,
are good to go.
great. तो चलो बच्चों, आज शुरू करते हैं. Sorry. चलो, नाउ वी आर गोइंग टू स्टार्ट अबाउट एनसीएलटी. सर एनसीएलटी का टॉपिक क्यों ले लिया यार? एक बच्चे ने भेजा और उसने ये बताया कि सर एनसीएलटी के बारे में बताओ. एनसीएलटी क्या है? पेपर के पॉइंट ऑफ व्यू से मुश्किल से आया भी तो 3 नंबर का आएगा. तो मतलब सीधी सीधी बात करें तो पेपर में इसको छोड़ा जा सकता है. छोड़ के जाओगे क्यों? बट ये बताओ ना. वी एट सुपर स्ट्रेट अवे बिलीव, वी एट दिव्य मिगलानी आल्सो, वी एट दिव्य मिगलानी क्लासेस आल्सो बिलीव कि कुछ छोड़ के नहीं जाना है यार. जैसे कुछ भी छोड़ के गए ना, गड़बड़ हो जाएगी पेपर के अंदर. अच्छा एक बात बताओ, अब स्टार्ट करते हैं, बट स्टार्ट करने से पहले मेरे को एक बात बताओ, इसको जानते हो? हाँ सर इसको जानता हूँ ना, ये ऐसे करके बैठा है, इसको जानता हूँ मैं. कौन है ये? सर ये ईशान अवस्थी. तारे जमीन पर, वो माँ वाला गाना आता था, रोता था ये. हाँ, हॉस्टल भेज दिया था इसको. बस 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 बस. सर आपने इसको जब भी ये इसके वाली पिक्चर देखी तारे जमीन पर वाली, तो इसको क्या देखा कि सर अगर ये कोई भी क्लास में उल्टा काम कर देता था, क्लास में टीचर कुछ पूछ रहा है, ये बाहर बैठ के आराम से चिड़िया को देख रहा है. ओ माय गॉड क्या बात है. कह रहा अब टीचर क्या करता था, इसको पनिशमेंट दे देता था. कह रहा हाँ सर. कह रहा ठीक इसी तरीके से अगर आप कोई भी ऑफेंस करते हो, उस ऑफेंस के लिए पनिशमेंट होती है. कह रहा हाँ. कह रहा देखो 2 तरीके होते हैं, ये सिर्फ एग्जाम्पल है, ऐसा करना मत जिंदगी में, ठीक है? कहीं कहो कि हाँ अरे हमारे सर ने बोला हमने तो दे दी. आप सर जा रहे होते हो तो आपने हेलमेट नहीं लगाया हुआ और ऊपर से आप सांप की तरह ऐसे बिल्कुल बाइक चला रहे हो. सांप बना दे, इसका सांप बना दे, ऐसे आप अपनी बाइक चला रहे हो. आप आगे जाके पुलिस वाला मिल जाता है और वो आपको कहता है ओए साइड पे लगाओ, साइड पे लगाओ, साइड पे लगाओ. आप रोक देते हो. वाह इतने शरीफ हो, आप रोक भी देते हो. और उसके बाद पुलिस वाला कहता है कि भाई चलान कटेगा. आप कहते हो नहीं नहीं सर चलान मत काटो, चलान मत काटो, मेरे से पैसे ले लो. और वो आपको छोड़ देता है. मतलब आप अपनी पनिशमेंट को इवेड अवॉइड कर सकते हो. कैसे? एक प्रॉपर पेनल्टी देकर, या मैं कहूं तो फाइन देकर. हाँ सर, बट वो फाइन नहीं, वो रिश्वत है सर, रिश्वत है. 1,000 रुपए का फाइन था तो मैंने उसको 100 रुपए दिए. मैंने कहा सर चुपचाप रख लो यार. एक बंदे को बोला, कहता यार, वो दूसरे वाले को बोला उसकी मुट्ठी गर्म करनी है, उसने मुट्ठी को उसके मुक्का मार दिया यार. कहता यार गर्म हो गया होगा हाथ, लट मार दिया उसके हाथ पे. कहता ऐसा नहीं चलेगा. अच्छा, अब कोई भी फाइन, अगर आपको पनिशमेंट मिलने वाली है तो उसके बदले में आप फाइन देकर छूट सकते हो. ओके, ये काम कौन करेगा? एनसीएलटी. मतलब सर रिश्वत नहीं नहीं नहीं. सर आप कभी भी कोई भी ऑफेंस करते हो तो उसके लिए 2 तरीके से सजा मिलती है. पहली होती है फाइन, कि भाई भाई जुर्माना लगेगा, जुर्माना लगेगा. और दूसरी होती है कैद. 7 साल कैद बामुशक्कत की सजा, ये बामुशक्कत की फांसी